If you've been investing for 5 years and you're still not seeing good returns, this might be the real reason. Please understand, what you think is happening and what is actually happening are two very different things. Most people believe that if they have been doing an SIP for 5 years, their money has spent 5 years in the market. But that's not true. In an SIP, you're not investing once. You are investing every single month, which means only your first installment has actually completed 5 years. Think about it. The money you invested 3 years ago has only completed 2 years. The money you invested last year has completed just 1 year. So when you look at your entire portfolio, on average, your money has been invested only for about 2.5 to 3 years, not 5. Please understand that equity investing is highly dependent on time. Not just your time, but your money's time. Now let's take a real example. If you had done a 5-year SIP in a simple Nifty 50 index fund in the last 5 years, your returns would be about 6.5 to 7%, which feels disappointing, almost like a FD return. So naturally, a lot of people start thinking, why take equity risk at all when I can just invest in an FD? But here's where the perspective changes. Take the same SIP and extend it to 10 years. Now your returns move closer to around 11 to 12%. And now compare that with an FD. An FD gives you around 6 to 7%, and after taxes that comes down to 5 to 6%. But in equity, after tax, you come down closer to 10% or 10.5, almost double. Now let's look at the numbers. Let's say you invest 20,000 rupees per month for 10 years. In an FD at 5%, your money grows to roughly 31 lakh rupees. But in equity at around 10.5%, your money grows to about 42.5 lakh rupees. That's a difference of more than 10 lakh. Nothing changed in your effort. Only two things changed: time and the asset that you chose. Now let me show you where most people make a big mistake. Let's say you were investing 20,000 per month for 4 years. That's about 9.6 lakh rupees invested. Then suddenly in the 5th year, you receive a lump sum of 50 lakh rupees, maybe from inheritance or some bonus. And you invest that entire amount in equity. Now your total investment becomes 59.6 lakh. Out of this, 50 lakh alone is more than 80% of your portfolio. Imagine if the market falls next year, your portfolio shows losses. At that point of time, a lot of people will say, I have been investing since 5 years and seeing losses in equity. But that is really not true, because only 80% of your entire portfolio has completed 1 year. So you're not actually a 5-year investor. You are a 1-year investor with a 5-year history. And that is a very important difference. Markets don't reward how long you've stayed invested. They reward how long your money has stayed invested. So the next time you feel your returns are not good enough, don't just look at the duration you have been investing. Look at the duration your money has been invested. If you found this useful, I break down such concepts regularly in my newsletter. You can find the link to it in the description.